You've been provided with the financial statements of Implats Limited. Now, before we're going to start with this question, let me tell you what is quite different in this question from the other questions that you have actually seen. Number one is your cash received from customers is a little bit more complicated. So therefore, we have to look at that calculation. Also, we have rental income, which I'm going to treat as a separately disclosable item so that you can see how to do that. I'm also going to show you the alternative method to calculate cash paid to employees and suppliers, where we are going to use cost of sales explicitly so that you know how it works. But guys, I'm just going to use that so that you can see how it works, so that you can take note that you can do it in that way. But like I've said before, I showed the way that I'm doing the cash flow statement is the quickest way, the shortest way, and give you exactly the same answer. So, and then there's some funnies in inventory. And yes, I think that is all the different stuff in this question. So definitely worthwhile having to look at. They give you the statement of profit or loss for the year ended 31 December 2014, sales, cost of sales, other income, operating expenses, profit before tax, tax expenses, and profit for the period. Then they also give you the statement of changes in equity. Now we have seen something like that before, and there you can see clearly, oh, it's so nice. They give you the proceeds on the issue of shares. They also give you the net profit after tax for the year, because there's profit for the period, but there's no tax. You can see clearly. And here you can see that there's profit for the year, and that, why is that exactly the same? Oh, there is your tax expense. Sorry, there is your tax expense. So 399,086, 399,086. And then they also already gave you the dividends, which was declared during the year. The statement of financial position. Well, the first thing that you see is that there's quite a 200,000 Rand jump in land and buildings. And when we go back to a statement of changes in equity, there is no revaluation surplus. If I go back to my statement of comprehensive income, well, they haven't shown me the other comprehensive income part, but there also is no mention from any revaluation surpluses. So by the looks of it, that increase of 200,000 must represent additional land and buildings purchased. They give me equipment, accumulated depreciation on equipment, and you see here, yes, accumulated depreciation on buildings. So that can actually, so this is definitely part of the accounting policy to have depreciation on buildings. Investment properties. Now here's our silent partner. Now you're going to do a lot about investment properties next year. That is a property, but that you hold, like the name indicates, for investment purposes. So there's an increase there of 10,000 Rand. Current assets, inventory, trade receivable, cash and cash equivalents. And then here's our ordinary share capital, our preference share capital, and our retained earnings. Again, no revaluation surplus. Loans, well, there was quite a difference there. Trade payables, accrued expenses. Remember, it's all about expenses. So we have to show that movement that took place when we work out cash paid to suppliers and employees. Taxation payable and shareholders for dividends. Okay. Number one, 70% of all sales are on credit. Now, let's have a look here. Prepare the statement of cash flow in compliance with IFRS for the year ended 31 December 2014 by using the direct method. Cash received from customers and cash paid to suppliers and employees must be calculated separately and may not be calculated as balancing figures. Guys, remember what I've said is, I said, well, your calculation, when I follow the direct method, for cash paid to employees and suppliers, that calculation is very close to my reconciliation note of profit before tax to cash out of operations. And if you've done your reconciliation note and you've done your cash received from customers, Well, then I think it is fairly easy to say, well, cash paid to employees and suppliers must be the balancing figure. Now, you can do it that way, except where the question tells you that this cash paid to suppliers and employees must be calculated separately and may not be calculated as a balancing figure. So if that is the instruction, you have to follow the instruction, otherwise you're not going to receive one single mark for the attempt. They say ignore that. No notes to the statement of cash flow are required, so I don't even have to do the reconciliation note, and comparative figures are not required. Great stuff. So let's start then with cash received from customers. They say 70% of all sales are on credit, and then included in operating expenses is an inventory write-down, which we are going to work with a little bit later now. Just want to mark that one. Depreciation, credit losses of 7,300 Rand. Guys, does credit losses that you write off affect your debtors account? Yes, for sure it does. So therefore I must make an adjustment for that. Is credit losses a cash flow item? No, it isn't. What did I do? I credited debtors and I debited credit losses expense account. No bank anywhere. So that is a non-cash flow item, which I will have to take into account. Then there was loss in the sale of buildings, finance charges. Other income consists of the following: rental income and dividends received. Then it's something about buildings, and then it's something about equipment, and then they gave you my share capital, authorized share capital, and then a loan. This is all about a loan. Great. So nothing else that is going to affect our debtors account. Now, I'm going to take the long road first, and then I'm going to show you the shortcut as well. Debtors. Let's do the debtors account, T account per se. So it will have an opening balance of 135,000 and a closing balance of 210,000. Opening balance 135,000, closing balance 210,000. Then they told us that 70% of all sales were on credit, so that it's only credit sales that's posted to your debtors account. So therefore, if I go to my income statement, there's my sales figure, so 70% of that would have been posted to my debtors account. Sales, 70% of 1,807,286, which gives us 1,265,100. Now, we've written off credit losses to the amount of 7,300, so there's that entry that we've passed in our books. So the balancing figure then in our debtors control account is amounts received from debtors, which is 118,800, and we drop it down. Now 70% of the sales was credit sales. The other 30% was cash sales. From whom did we receive that cash? From the customers. So what do we have to do with cash sales? We have to add it to these amounts received from debtors. So cash sales, 30% of 1,807,286, which gives us a total of 542,186. So net cash received from customers, 1,724,986. Let me show you the shortcut. The shortcut, I'm going to take the full amount of my revenue, the full 1,807,286. I'm going to adjust it for the movement in debtors. Now, debtors have increased from 135,000 Rand to 210,000 Rand. But looking at this account here, have they received the full 135,000 Rand, which was outstanding of last year's balance? Because that's what movement in debtors imply. They say, well, I've received the opening balance, but the closing balance is still outstanding. If I did write off credit losses of 7,300, have I received the full 135,000 Rand? No, guys, I haven't. So therefore, I have to add back the 7,300 to the 210,000 And then I'm going to compare that to last year's 135,000 Rand. The other way that you could have argued is that I have to take the 135,000 Rand and then minus 7,300 Rand from the 135,000, and then I would have gotten to the amount that I've received in respect of last year, which equals 127,700. And that I'm going to compare with my outstanding amount at the end of the year of 210,000, and that will give me, in fact, again, that outflow, that increase in debtors of 82,300. So let me write it down for you here as well so that you can see. There you are. I could have said my opening balance was 135,000 Rand. Have I received the full amount? No, I haven't. What haven't I received? I haven't received the amount that was written off eventually as credit losses, which was 7,300 Rand. It says, well, now how much did I receive from last year's outstanding figure? 127,700. How much is still outstanding of this year's sales figure? I had credit sales of 1,265,100, but 210,000 Rand of that has not yet been received. This 210,000. So that will then tell us that there was a movement of 82,300. Great stuff. Now that 82,300 is exactly the 82,300 that you actually see there on top. Let's color that in for you. Right. Okay. Now let's do it. We go and park that figure there. Cash received from customers, and there we're going to park it 1,724,986. The next one that we're going to calculate is our cash paid to suppliers and employees. But we have told each other before we actually attempt this calculation, let's do our PPE accounts first, because there's a lot of things that we're going to pick up out of the PPE accounts that have an impact on that figure as well. Okay. Here in operating expenses, we had depreciation, which they gave us. They gave us a loss on the sale of buildings, and it seems to be all. Now they tell us buildings, so open up a T account, land and buildings. Where's my land and buildings? T account, land and buildings. Opening balance 4 million, closing balance 4.2 million. Open up accumulated depreciation buildings, opening balance 1,065,000, closing balance 1,080,000. So there's our cost, 4 million, 4.2 million, accumulated depreciation 1,065 and 1,080. Then we're ready for action. Depreciation was a total amount, so I cannot use that one in the buildings account per se. Buildings with original cost price of 500,000. Purchased on 1 July 2010, was disposed of at a loss on 31 December. Further buildings and equipment were acquired to maintain operations. Maintain is replacement. The plant or the building is depreciated over its useful life of 25 years to a zero residual value on the straight line basis. They gave us the purchase date, 1 July 2010. They've told us what is our depreciation policy. And we know that we are currently now at 31 December 2014. And this building was disposed of as of 31 December 2014. We also sit with final figures, so included in our total depreciation charge for the year, which is included in operating expenses, must be, it's that 110,000, must be all the depreciation that was passed for the current year, also based on this building that we've sold. Now, in order to determine what was the proceeds of the sale of the building, we have to take out the cost price and the accumulated depreciation as at the date of sale. So the cost price of that building on 1 July 2010 was 500,000. We depreciate the full 500,000, no residual value over 25 years, and from 1 July 2010 to 31 December 2014, that date up to that date, is exactly 54 months. 6 months in 2010, 12 months in 2011, 12 months in 2012, 12 months in 2013, and 12 months in 2014. So if I add it all up, it gives me a total of 54 months. And that means that the accumulated depreciation attached to that building which was sold was 90,000 Rand. So we're going to take out the 90,000 out of our accumulated depreciation, drop it down to our asset disposal account. We're going to take out the cost price of 500,000 as a cost price, and we're going to drop it down to our asset disposal account. They told us in the question that we've made a loss on the sale of the buildings of 5,000 Rand. So that we're going to record in our asset disposal account, lost 5,000, and now we can determine that the proceeds on the sale was 405,000. Guys, and we have that 405,000, so let's go and dump it in the correct place. Cash flow from investing activities. Additions, no, it was not yet, it was proceeds on the sale of plant, 405,000 Rand. Let's write it there, proceeds on the sale of plant, 405,000 Rand. Great. Going back to this calculation which we've done here, is now we can determine what was the depreciation on our land and buildings itself. That is then our balancing figure of 105,000. And in our land and buildings at cost account, when we balance that off, we see that we've acquired new land and buildings to the value of 700,000. And we can go and dump that where it should be in the investing activities. Additions to fixed properties, a cash outflow minus or a bracket, 700,000 Rand. And they've told us, if I'm not mistaken in the question, it was to maintain operations. So if it is to maintain operations, it is for replacement. It's not uitbreiding in Afrikaans, it is vervanging. Great, so now we have dealt with that one. Going back to these calculations, we now can do we are finished now with buildings, so let's carry on with equipment. No equipment was disposed of during the year. Okay, so let's then do our equipment accounts. Cost price, opening balance, closing balance, accumulated depreciation, opening balance 125,000, closing balance 130,000. Now, equipment account, when we're going to balance it off, you can assume that this must be for expansion purposes because there was nothing that I've sold. So if I didn't sell anything, what can I replace? So expansion purposes, 1,105,000, and I'm going to put that where it should be, cash flow from investing activities, additions to equipment for expansion purposes, 1,105,000. We can quickly just go and check our depreciation. Well, we have 5,000 there if we balance off this account and 105,000 in my land and buildings account. And when we go back here, you see exactly there is the 110,000 total depreciation for the year. I think this was all the PPE accounts that we have to redo and to get figures out of. So let's go back to our second line item. Cash paid to suppliers and employees. And our starting point for that is profit before tax. So profit before tax, 554,286. So in either one of the two methods that you're going to use, your starting point is going to be with your profit before tax, 554,286, 554,286. The first adjustment that we're going to make is for non-cash flow items. Now, those that we've picked up in our accounts here, we can use that immediately. Depreciation, 110,000. Loss on the disposal of buildings, 5,000. Then going back to the question itself, I've told you that we have now depreciation, we have the loss, credit losses. We said that that is a non-cash flow item, so I have to adjust under non-cash flow items my profit before tax with credit losses. What does credit losses do? It decreases profit before tax. So if I want to eliminate that, I have to add it back. Inventory write-down, 75,000 Rand. Guys, what is the inventory write-down? What is my entry? I credit inventory and I debit the inventory write-down account, which eventually is closed down against cost of sales. So there's no bank involved there either. It's the same thing as a credit loss. I just decrease the balance of an asset account. So therefore that inventory write-down of 75,000 is also a non-cash flow item that I have to take note of. So let's see whether we have all the non-cash flow items now. We have the inventory write-off, we have the depreciation, we have the credit losses, we have the loss on disposal. Great. Now we have to adjust it for separately disclosable items. I have to add back my finance charges to my profit to eliminate that. We're going to treat rental income as a separately disclosable item, so that has increased my profit, and in any event you have to deduct it here. Why? Because it's income. If I did not treat rental income as a separately disclosable item, I had to add that 75,000 Rand to cash received from customers. So that is my choice. I must either add it to cash received from customers or deal with it as a separately disclosable item. Now, we are going to deal with it as a separately disclosable item. But income has never been anything to do with expenses. So regardless of which way you're going to treat rental income, either as cash received from customers or as a separately disclosable item, because it is an income figure, that is the reason, because it's an income figure, I have to eliminate that out of my cash received, cash paid to suppliers and employees. And then dividends received, that is a separately disclosable item, so I have to deduct that from my profit before tax as well in order to see how much expenses was staying behind in my income statement. Then obviously, because we have used revenue when we actually determined, I just want to color it in a different color. Revenue, when we actually determined what was our cash received from customers, that was our starting point, and that is also an income figure, so I have to remember to take that out as well. There is our rental income. Great. So what stays behind, guys, is exactly the same thing. Yes, it's an income item, it will be on the credit side. If it's an expense item, it will be on the debit side. So you will see that you're going to remain in your P&L account. There will be a balancing figure of all my other expenses of 110,700, and I'm going to start with that, 110,700. Now, I have to adjust that for my accrual principle. So therefore, I have to go back to my statement of financial position under working capital changes. Inventory. Inventory has increased quite a lot, from 290,000 to 430,000. But guys, remember that taking that into account, we have also written off 75,000 Rand worth of inventory. Now, think about the inventory account as a T account. You will have an opening balance, you will have a closing balance. You will have purchases of inventory items and purchase-related costs on the debit side, and you're going to have cost of sales on the credit side. And then it's going to be in balance. Now, when there's a write-off, what did we tell each other, especially in the first semester? We said, well, balance off the account first, and then you do the NRV adjustments. Why? Guys, because that amount of purchases that bank amount in my inventory account is going to be affected by this NRV, and it cannot be affected by the NRV adjustment if you do not firstly balance the account off and then account for the write-downs. Remember, like I say, now think clearly in your head. Opening balance plus purchases, let's say that's bank, less on the credit side cost of sales and closing balances. So that is in a perfect world. Those things will be in balance. But if I'm going to put an inventory write-down on the credit side, what is the impact of that on my bank amount if I use that as a balancing figure? It's going to reduce my bank amount. But is my inventory purchases dependent on any write-downs that I as a company decide to do against inventory? No, it isn't. So therefore, that is the reason why I say balance off the account first, and then you're going to determine what write-downs you're going to do. Now, out of a cash flow perspective, it is easy to argue in the following way. You say, well, my inventory balance in my statement of financial position is 430,000 Rand. After I've written down that inventory of 75,000. So what was the balance before the inventory write-down? 430,000 plus 75,000. So 505,000. And that is the amount that I'm going to compare with last year's inventory figure of 290,050. I cannot do this change with write-downs because the write-down does not represent cash flow. I first have to adjust that figure to what it was before the write-down, get an answer and compare that figure before the write-down with last year's figure of 290,050. So decrease in inventory, 430,000 plus 75,000 less 290,050 gives us then a total of 214,950. It's quite important. Right, for the rest, it's straightforward. Trade payables. There's a decrease in trade payables, so it's a cash outflow. And then I have accrued expenses, where there's also a decrease in accrued expenses, which also means it is a cash outflow. So decrease in creditors, a cash outflow, decrease in accrued expenses, also a cash outflow. So that's going to leave us with cash paid to employees and customers to the value of 1397150. And I'm going to park it here. Cash paid to suppliers and employees 1397. Oops, no, this one is a little bit cockeyed. 1397150. Coming back to this calculation though, this one. I want to show you if I took an alternative way of calculating this 1397150. In this way, they actually calculate how much was the actual amount paid to the creditors being the suppliers. And then they're going to say, well, I have that amount and I have made a calculation, so therefore I can assume that the rest was for employees and whoever. Now, for that one, in order to determine how much was actually paid to suppliers, I have to do the creditors account. What account goes hand in hand with the creditors account? The inventory account. So therefore, what I'm going to do is, I'm going to do my inventory account. I'm going to use the opening balance of my inventory as they gave it to me, 290,050, closing balance 430,000 Rand. Now remember, I cannot take the 430,000 Rand because the 430,000 Rand was after I've done the inventory write-off. So we say if we want to determine what cash flow was, I have to add back that 75,000 Rand because I have to work with a closing balance before any write-downs has taken place. So my actual balance before any write-downs were taken place was 505,000. They gave me in the question my cost of sales. I know that that is an entry which happens on the credit side of my inventory account. So I can go and post cost of sales now. Now when I balance off this account, I'm going to get the amount paid or the amount of credit purchases. The amount of credit purchases, 1014950. Now I know that the counter leg of credit purchases is in the creditors account. So I'm going to post that to the creditors account. Remember what I'm after? I want to see how much money did I in fact pay the creditors during the course of the year. Going back to the inventory account, you can clearly see that I've done the inventory write down after I brought down the balance of 505,000. Then I'm going to do the inventory write down, and then you will have the closing balance of 475,000 Rand. Going to creditors, we said, well, creditors in our statement of financial position had an opening balance of 225,000 and a closing balance of 149,000. Closing balance, opening balance. That was our credit purchases for the year, 1014950. I refer you to incomplete records. So now we can determine as a balancing figure what was the actual amount paid to suppliers for the year, 1090950. Now the first part of this calculation is exactly what we had here, the 1102700. Then we say, well, here we say all other expenses paid, but by implication, if you look at this, cost of sales was already included in all those other expenses. That was lying here somewhere in the account. So if cost of sales was already included in the 1102700, we must now take it out of that amount. Otherwise, we're going to double count for that amount of cost of sales. So we're going to add it back. We say, well, that is the total expenses, but included in those expenses is 800,000 Rand, which belongs to cost of sales. So let's adjust that figure furthermore with cost of sales. And then we're going to carry on here. We're not going to do the inventory and the trade creditors because we have done here the calculation of the actual amounts paid to suppliers, and we're going to put that in our calculation. The only other thing that actually stayed behind here is accrued expenses, and that has an impact on expenses, so we must still take the accrued expenses into account, and that is that figure there. So once I've done all these adjustments, I'm going to derive at that figure there, which is net cash paid to suppliers and employees, and it's exactly the same figure as this one. But can you see why I'm saying you have to take note of this calculation? Because I'm just scared in other years. I'm not going to ask you this because I think it's a waste of time. But from next year onwards, you may encounter questions asked by your lecturers which they want you to use cost of sales for some or other reason. Maybe there's more inventory adjustments that took place, maybe more balancing figures that you have to calculate, where you probably will have to use this method in order to derive at the final figure. So go through this, just look at the rationale behind that, keep it somewhere in the back of your mind. I'm not going to make this, a cash flow statement question is not difficult, but it's very long. So I'm not going to make it even longer by insisting that you use this method. But if you do use this method, it is not wrong. I have to mark it correct. But I don't know why you want to waste your time with things like that. Great, now our separately disclosable items. We said we're going to treat rental income as a separately disclosable item. So therefore, on part of my cash flow for operating activities, rental income, 75,000, separately disclosable. Dividends income. Dividends received, that is also separately disclosable income. Dividends received, 60,000. Dividends paid. The question actually gave me dividends paid. They gave me shareholders for dividends, so I have to open up a T account, opening balance, closing balance, and they gave me the dividends which was declared for the year. Dividends declared, 312,586. So here in our accounts, shareholders for dividends, opening balance 12,550, closing balance 7,000, retained earnings with a dividend declared of 312,586, and that then gives us a balancing figure for our bank, 318,136. Dividends paid, 318,136. Remember cash outflow, therefore the minus sign. Tax. Now, according to my statement of financial position, taxation payable, opening balance 109,500, closing balance 31,500, and my expense for the year 155,200 in the income statement. Opening balance 109,500, closing balance 31,500. There's my tax charge in the income statement, 155,200. So therefore my balancing figure, actual tax paid to the receiver for the year, 233,200. 233,200. Then finance charges. I think they gave it to us in the, that's not there. Additional information as well. Finance charges, 88,000 Rand. So I can go and I can put that on the face. Interest paid, 88,000. Now when I actually add all those items together, I'm going to get to the net cash outflow from operating activities, 176,500. Cash flow from investing activities, we had the fixed property thing. Investment properties, that's the one that we didn't have. If you look at your assets here, investment properties increased with 10,000 Rand. So it's an outflow of cash, additions to investment properties. We have the proceeds on the plant and we have the additions to equipment. So all you can do is to add those items together to get my net cash outflow if investing activities, 1410. Then net cash outflow from financing activities. Now guys, there's not a lot of information here. If I go and have a look at my equity and liability section of my statement of financial position, loans, clearly there was a repayment of loan. They tell us also that there was no further transactions concerning loans. So the difference then is a repayment of 702,500. And then our share capital. Now that we could have picked up in the statement of profit or loss, a statement of changes in equity as well. Ordinary shares issued 500,000, preference share capital issued 1.6 million. Rather that you actually, you're not allowed to net off, so ordinary shares issued, the proceeds was 500,000, preference shares issued was 1.6 million Rand. And then I can actually complete this, get the total cash outflow from financing, cash inflow from financing activities, 139,700. And then the easy one is cash and cash equivalents in the beginning of the year, which was 215,000, end of the year 226,000. So there was a decline, an outflow of 189,000 Rand in cash and cash equivalents. Going back here, if I take the minus 170, look here, they had an outflow of cash out of operating activities, which is not a healthy thing. And if you look here, what is the reason for that? Look there. They paid far too much dividends. You cannot do anything about the tax because you've earned the income if you pay the tax. But you can definitely do something about dividends. So they paid out far too much dividends. The cash flow out of operating activities was only 327,000 and they paid out nearly the full amount in dividends. Very, very stupid. There's also an outflow of cash in investing activities. There was quite an inflow of cash, which actually covered most of the outflow in investing activities, which is fine. And then the decrease in your cash and cash equivalents. And if they're going to continue with these kind of practices, then that cash position of them is going to continue to be under severe pressure.